Welcome back, focused learners. Today, we're jumping right into one of the most bizarre financial mysteries Wall Street has seen in a while. I like to call it the Sirius XM paradox. See, on one hand, you have a company trading at what looks like absolute bargain basement prices for a technology a lot of people associate with their grandpa's car. But on the other hand, you have the greatest institutional investor of our time backing it heavily. How can a stock look so mathematically broken, yet attract the smartest money in the room? Well, let's dive into this and solve the puzzle together.
Think of today's explainer as an investigation dossier. Here's our roadmap. We'll start with the Berkshire Hathaway paradox, then we're uncovering the red flags, revealing the green flags, running a value framework face-off, diving into the moat debate, and finally we'll get to the final verdict.
All right, part one, the Berkshire Hathaway paradox.
So we are talking about Sirius XM. You know them, America's satellite radio giant, famous for their exclusive FCC spectrum licenses, dashboard dominance, and stars like Howard Stern. But here is the number that makes this a total mystery: 37%. Warren Buffett's Berkshire Hathaway owns an absolutely staggering 37% of this company. Guys, that equates to a $3 billion bet. The world's greatest long-term investor is essentially all in on a company that much of the mainstream financial press is completely writing off.
Which brings us to the crucial question we need to answer today. Is this a classic value trap, or is it a hidden gem? Because if you just look at it on paper, the valuation is jaw-droppingly cheap. You've got a price-to-earnings ratio of just 12, which is a massive 40 to 50% discount to the broader market. The price-to-book ratio is 0.58. Think about that. You are literally buying a dollar of assets for 58 cents. Plus, it pays a really secure 3.6% dividend. It sounds absolutely perfect, right? But we need to know exactly why it's priced this cheaply.
That brings us to part two, uncovering the red flags. The market's absolute biggest fear right now is stagnation. If you look at the 5-year trajectory from 2021 through the 2026 estimates, revenue has essentially flatlined. Actually, it shrunk slightly, dropping from a peak of $9 billion down to $8.58 billion. And in the investing world, a shrinking top line is like a massive siren blaring in the background. The business just looks stuck in neutral. But honestly, the top line is really just the beginning of the problems here. First, look at the fundamentals. Return on equity is hovering around 7 to 9%. Return on invested capital is just 4.55%. And the balance sheet is loaded up with high leverage at 4.57 times net debt to EBITDA. Then, you've got this terrifying leadership vacuum at the top. The CEO recently dumped 47.6% of her shares near 52-week highs, and the COO just resigned with absolutely no replacement named. Add in some incredibly dismal analyst targets of around $31.31, plus the massive existential threat of Spotify and Apple Music basically eating their lunch, and yeah, you have a very bleak picture.
It's really no wonder we're seeing assessments like this one from Guru Focus. The company's ability to grow subscriber base has been limited. For a lot of growth-hungry investors out there, SiriusXM is simply seen as dead money, with absolutely no real prospects for expansion.
But hold on, let's pivot to part three, revealing the green flags.
Because what the bears are completely missing here is the sheer cash power of this business. That deep discount we just talked about, it's backed by a massive 18.4% free cash flow yield. They are generating $1.5 billion, which easily secures that 3.6% dividend. Furthermore, Q 2026 showed a huge turning point with positive net subscriber growth and raised guidance, which was really fueled by innovations like their $5 a month Sirius XM Sports Pass. And the best part? Insiders own 39.2% of the company, meaning their money is exactly where yours is, which actually helped spark a massive 53.8% rally over the past year.
Now, contrast that earlier pessimistic quote with this incredible finding. Joel Greenblatt's famous magic formula, which rigorously screens for high earnings yield and return on capital, actually gives SiriusXM a flawless 100% rating. By that strict quantitative measure, this setup is absolutely perfect.
Okay, let's put it to the test in part four, value framework face-off. First up, we're bringing in the father of value investing himself, Benjamin Graham. His verdict? Mixed, sitting at a 57% match. See, Graham would absolutely love the cheap price-to-earnings and price-to-book ratios, but he would be deeply spooked by the dangerously low liquidity. A current ratio hovering between 0.30 and 0.46 means there just isn't a clear enough margin of safety for his strict balance sheet standards. Next, we bring in Peter Lynch, the absolute champion of growth at a reasonable price. His verdict is also mixed, coming in at 74%.
The stock is cheap, sure, but Lynch's framework hits a wall here because he demands growth. Sirius XM actually has a negative PEG ratio because earnings are shrinking, and a 5-year earnings growth of just 2.1% just doesn't cut it for him. He'd probably say to watch it, but don't buy it quite yet. And finally, we reach the Warren Buffett verdict. And guys, this is where our entire explainer peaks because it's a total paradox. On paper, Buffett's own quantitative framework gives Sirius XM a 0% rating. It completely fails his strict 15% thresholds for return on equity and return on invested capital. And yet, his actual checkbook says otherwise, right? Berkshire owns 37% of it. His formula says fail, but his money is screaming buy.
Which leads us directly into part 5, the moat debate. The entire investment thesis really hinges on one massive tug of war. The case for their economic moat rests entirely on regulatory monopolies. We're talking exclusive FCC spectrum licenses that literally no one else can replicate, combined with the fact that they are pre-installed in over 90% of new car fleets. But the case against the moat is relentless technological disruption. With connected cars, apps like Spotify and Apple Music are completely bypassing the satellite, eating directly into Sirius XM's dashboard dominance. It's your classic battle of legacy infrastructure versus modern streaming.
All right, let's wrap this investigation up with part 6, the final verdict. Here are the core findings you should take away from this explainer today. Sirius XM is the ultimate contrarian bet on a business that currently shows declining growth. However, in exchange for taking on that really high transformation risk, you're getting a historically cheap valuation and a massive 18% free cash flow yield. And you simply cannot ignore the incredibly powerful institutional signal of Berkshire Hathaway holding a 37% stake.
If you are following this story, you definitely need to mark your calendars for the upcoming catalysts. The next critical checkpoint is the Q3 earnings report on November 3rd, 2026. That report will show us if that Q2 subscriber turnaround was just a fluke or a real trend. Also keep a close eye on that sustainable 27-cent quarterly dividend, because as long as the cash keeps flowing, investors are basically getting paid to wait and see if the turnaround works.
So, focused learners, we've presented the paradox. You've seen the red flags of a shrinking top line and the green flags of massive cash generation, plus Berkshire's multi-billion-dollar blessing. Now I want to hear your final judgment. Look at the facts we laid out today. Is Sirius XM a hidden gem just waiting for a massive rebound, or is it the ultimate value trap disguised by a famous billionaire's backing? Let me know what you think in the comments below. Keep learning, keep analyzing, and I'll see you in the next explainer.